Hello, it's ChewDog Charts. If you like dividends, the Dow Jones Industrials are a great place to start. All 30 components of the Dow pay dividends, and the blue chip companies that make up the average are among the biggest and most important businesses in the global economy. Now, you can invest directly in the Dow through exchange-traded funds, but many investors prefer a strategy that emphasizes dividend income, and this is known as the dogs of the Dow. The strategy involves buying a set of stocks at the beginning of each year and holding them for the entire 12-month period, and then repeating the process in subsequent years. Being a chew dog, I love the dogs of the Dow. So let's take a look. Now, this is a list of the 2018 Dogs of the Dow. The list comes from dogsofthedow.com. The Dogs of the Dow strategy calls for investing an equal amount of money into each of the 10 highest yielding stocks, owning them throughout the entire year without any turnover until the following year. Now, in 2018, the Dogs of the Dow have a chip on their shoulder because 2017 gave this strategy a relatively poor performance. The Dogs returned just 19% in 2017 compared to a 25% rise in the Dow as a whole. Although dividend income was slightly higher for the Dogs, it wasn't enough to make up a 6% point shortfall. Before that, though, the Dogs had produced outside returns in 6 of the 7 previous years, missing only 2012. As a long-term strategy, the Dogs have been relatively mixed with roughly equal numbers of market-beating and market-trailing returns. For 2018, the biggest thing to watch is whether the energy segment bounces back. With both of the Dow's integrated oil giants as well as General Electric among the dogs, a recovery in oil and natural gas could spur outperformance. By contrast, if underrepresented trends in the dogs such as industrials and financials continue to do well, then the dogs could suffer another defeat to the Dow in 2018. Now today, we're only going to talk about one stock, Pfizer. And that is because I've previously talked about some of the other stocks, and in the future I have other videos coming up with regard to some of the others, including international business machines. So for today, we're going to talk about Pfizer. So let's take a look. Pfizer's chances of being a winning member of the Dogs of the Dow in 2018 may have improved following its recent decision to increase its quarterly dividend by 6.3% to 34 cents per share and to add $10 billion more to the $6.4 billion remaining on its share buyback program. Pfizer sales have fallen significantly in the wake of losing patent protection on Lipitor in 2011, but the company finally appears to be turning an important corner. While Lipitor's sales are still sliding, they're declining from a much lower level, and as a result, Pfizer's fast-growing drugs are offsetting those declines and helping revenue tick higher. Pfizer is expected to report full year 2017 results in February 2018, and based on guidance, that report could show the company is continuing to make headway toward becoming a growth stock again. In November, Pfizer guided for 2017 revenue of between $52.4 billion and $53.1 billion and adjusted earnings per share of at least $2.58. Existing drugs will undoubtedly remain important catalysts for growth in 2018, but there are other drugs in Pfizer's pipeline that could make the stock a winning dog of the Dow in 2018. It has 18 oncology drugs in clinical stage studies and expects to initiate 3 to 4 pivotal studies over the next few years. Overall, improving financial and tailwinds associated with a bigger dividend payment and buyback authorization could improve Pfizer for 2018. So let's take a look at the stock charts. The chart we're looking at is the 20-year monthly chart on Pfizer, and the symbol is PFE. For disclosure purposes, I do not hold any positions long or short in Pfizer. The current price intraday is $36.46, and as we can see here, we've bounced off of the 50 EMA here in early and in late 2016 with a move above the 20 EMA up to the current time frame. Moving down into the MACD, we see that the MACD was trending downward and has consolidated here with a recent move of the fast line through the trigger line in, say, mid-2017. Moving down, much the same in the histogram into the momentum indicator. This is somewhat non-committal, moving up and down the zero line. We're currently above the zero line. Much the same here in the price rate of change, nothing significant, but we are mostly above the zero line here for a good part of its last several years. Into the relative strength, we have a moderate 66.01 measure. And looking at this chart here, what I see is somewhat the same as the MACD, as we have a downtrend, a consolidation, and then the upward move, a nice dish. Into the stochastics, much the same as well. A move down, consolidation, and then perhaps an upward move. Into the volume, this is moderately negative, nothing significant. I'd like to see better volume than this, but it's all right. And into the Williams also shows much the same, the move down, the dish, and then the move up. I like the number of years in the consolidation. The longer the consolidation, the better the upward move can be. Moving back up into the price chart. Again, we are here bouncing off of the 50 EMA through the 20 EMA. Right now, we're at a general trend line, if you can draw it that way. I'd like to see a move above the recent highs, and if the price does move above that, perhaps there's some blue sky ahead of Pfizer. So for now, that's ChewDog Charts. Thank you.